Somewhere inside a set of vaults in New York and Delaware, a number just moved that almost nobody outside the futures market pays attention to, and it moved before the number everybody else is watching, the one coming out of the Federal Reserve on July 29th. If you only follow headlines, you'll hear about the Fed decision after it happens. The people who trade physical metal for a living watch something else first, days or even weeks earlier, and it has a way of telling you which direction the bigger story is about to break. That signal just flashed again. Once you understand what it actually means, you probably won't look at a gold or silver price chart the same way again. Most of what moves gold and silver prices on the news is paper. Futures contracts, ETFs, options, promises stacked on top of promises, layered so many times that the actual physical metal sitting in a warehouse becomes almost an afterthought. Almost, at a few very specific moments each month, that physical metal stops being an afterthought and becomes the entire story. This is one of those moments, and it's landing almost to the day alongside the most important Federal Reserve meeting of the summer. Let's start with what actually happened, because the mechanics matter more than the drama. Every month, COMEX, the commodities exchange in New York, where most of the world's gold and silver futures trade, approaches something called First Notice Day. That's the date when traders holding a futures contract for the current delivery month have to decide, close the position out for cash, or actually stand for delivery and take real physical metal out of a vault. Most of the year, almost everybody rolls their contracts forward or cashes out. Physical delivery is rare, small, and boring, except when it isn't. Right now, heading toward the August contract, there are still more than 1,800 silver contracts open just days before First Notice Day. That might sound like a small number, but each Comex silver contract represents 5,000 ounces. Do the math, and you're looking at roughly 9 million ounces of silver, where the buyers haven't decided yet whether they want cash or metal. Normally, by this point in the countdown, that number has shrunk to almost nothing. It hasn't. That's the first piece of the signal. The second piece is the one that should actually get your attention. Exchanges like Comex split their warehoused metal into two categories. Eligible metal meets the exchange's quality standards but isn't earmarked for delivery, sitting in reserve. Registered metal is different. It carries an active warehouse warrant, meaning it can be handed over to satisfy a delivery request right now, no paperwork delay. When analysts talk about a coverage ratio, they're comparing how much registered, deliverable metal exists against how many paper contracts are outstanding and could theoretically demand delivery. Right now, that coverage ratio for silver sits at just over 18%. Below 15% is historically considered stress territory, rare, and usually associated with real delivery squeezes. 18% isn't a 5-alarm fire. It's close enough to the alarm that people who track this for a living aren't looking away. There's a piece here that makes this genuinely interesting instead of just technical. Registered silver stockpiles have actually been rising, up more than 10% over the past 30 days, with the total now sitting above 96 million ounces. On the surface, that sounds reassuring. More registered metal should mean less stress, right? Except paper leverage. The ratio of outstanding paper claims to the metal actually available to back them is still running at roughly 5.5 times. In plain English, for every ounce of silver that could be handed over immediately, there are more than 5 ounces worth of paper promises floating around the system claiming a piece of it. That gap between paper claims and physical metal is the kind of tension that, historically, has come before some of the sharpest moves silver has ever made. Before you picture something dramatic like an empty vault, it's worth being precise about what this is and isn't. It isn't evidence of fraud, and it isn't evidence that Comex is somehow out of metal. Registered and eligible stockpiles move between categories constantly, and a lot of that is administrative, metal getting reclassified rather than physically moved. What it is, though, is a real measure of how tightly stretched the physical layer of the market has become relative to the paper layer sitting on top of it. Think of it like a bank's reserve ratio. Banks don't hold every depositor's cash sitting in a vault, and that's not a scandal. That's just how banking works. But if too many depositors show up at once wanting real cash, a bank that looks fine on paper can suddenly look very different in practice. Precious metals markets have their own version of that dynamic, and right now the numbers are drifting toward the tighter end of it. Why should this matter to you if you're not a futures trader, if you've never bought a single ounce of silver in your life? Because retail investors, the people buying coins, ETFs, mining stocks, sit downstream of this exact mechanism. When physical tightness builds in the wholesale market, it eventually shows up in premiums at the coin shop, in ETF share creation costs, and in the spot price everybody sees quoted on their phone. The Comex vault is the plumbing. Most people only notice plumbing when it backs up. This particular moment in the plumbing is arriving at nearly the same time as the biggest scheduled catalyst of the summer for both metals, the Federal Reserve's July 28th and 29th meeting. Two major forces are converging on the calendar at once, and most casual investors are only paying attention to one of them. So take the one everybody already half expects, even if they don't fully understand why it matters as much as it does. Gold and silver don't pay you interest. They don't pay a dividend. They just sit there being metal the way they've done for 5,000 years. That single fact is the whole foundation of their relationship with interest rates. When the Federal Reserve raises rates or even signals it might, other assets like treasury bonds, savings accounts, and money market funds start paying you more just for holding cash equivalents. That raises what economists call the opportunity cost of holding gold and silver. You're giving up a guaranteed yield to hold something that pays you nothing. When rates fall or even just stop rising, that opportunity cost shrinks and metal becomes relatively more attractive. It's close to that simple, at least at the level of mechanism. Where this month gets more complicated than a textbook explanation is worth sitting with because it's the part most casual coverage skips. Back in mid-June, the Fed's rate setting committee released its quarterly economic projections, the dot plot, so-called because each policymaker's individual rate forecast literally shows up as a dot on a chart. Of the 18 participants who submitted projections that month, 9 expected at least one more rate hike before year-end. 8 expected no change at all. 1 expected a cut. That's about as divided as this committee gets. Notably, the Fed's chair didn't submit a dot of his own, a quiet but deliberate signal that even the person running the meeting wasn't ready to commit to a single path forward. When the minutes from that meeting were published a few weeks later, gold actually fell, sliding toward the $4,000 mark because the minutes revealed a more hawkish undertone than markets had fully priced in beforehand. There's a lesson buried in that. It's rarely the headline decision that moves markets the most. It's the gap between what was expected and what actually gets said. A hold delivered with hawkish language can hurt gold more than a small hike delivered with dovish reassurance. Direction matters less than surprise. Then came the June inflation data in mid-July, and the picture started shifting the other way. The report showed price pressures easing off just enough to nudge market expectations back toward a Fed that holds rates steady at the July meeting rather than surprising anyone with a hike. As of early this month, futures markets were pricing roughly an 80% probability that the Fed holds and only about a 20% chance of a hike. That sounds like a low drama outcome. Low drama on the headline doesn't mean low drama in the metals. Here's the wrinkle in: the market already expects a hold. If a hold is fully priced in, and the Fed delivers a hold with no surprises in the language, gold and silver may not move much on the announcement itself since the good news already happened in the run-up. What actually moves the needle from here is what Fed Chair Kevin Warsh says in the press conference afterward, specifically about September, because this July meeting doesn't come with a fresh dot plot or updated projections. The next meeting that does is in September, so the words Warsh chooses about the path ahead matter in a real sense. More than the rate decision itself, I'd argue that's worth remembering the next time you watch financial news cover a Fed meeting. Watch for the language, not just the decision. In a market this closely calibrated, the language often is the decision. Silver has been behaving differently than gold lately, and the reason is worth understanding on its own terms. In the days leading into this Fed meeting, silver has moved by multiples of gold's percentage moves, gaining nearly 5% in a single session on some days, while gold moved a fraction of that. There's a documented mechanical reason for this. When rate hike expectations fall, silver historically moves 2 to 3 times the percentage that gold does in either direction. Silver is smaller, thinner, and more sensitive to shifts in speculative positioning than gold's larger, more institutionally dominated market. It amplifies whatever gold is already doing, but silver has a second engine that gold doesn't have, and this is what actually separates the two metals in 2026. Gold is overwhelmingly a monetary and reserve asset, with central banks, investors, and jewelry demand dominating its story. Silver runs differently. According to the Silver Institute's most recent annual survey, close to 58% of all silver demand now comes from industrial applications, solar panel manufacturing, electric vehicle production, and the build-out of data centers powering artificial intelligence. Silver conducts electricity extraordinarily well, and each of those industries needs it in ways that have no easy substitute at scale. That means silver isn't just responding to interest rate expectations the way gold does. It's also responding to industrial demand sentiment, whether the solar build-out is accelerating, whether EV production is picking back up, whether AI infrastructure spending keeps compounding the way it has for the past few years. When rate cut hopes and industrial optimism improve at the same time, silver gets pushed by two forces at once, which is part of why its moves look outsized next to gold's on any given day. There's a structural fact underneath all of this that doesn't get enough attention. 2026 marks the sixth consecutive year the global silver market has run a supply deficit, meaning the world is consuming more silver than mines and recycling combined can produce. Estimates put this year's shortfall north of 46 million ounces. 6 years running of drawing down stockpiles to make up the difference isn't a one-off blip. It's a structural trend, and structural trends don't resolve quickly. Mines take years to permit and build. New silver supply doesn't appear over a single quarter just because prices moved. Put those threads together and you get a useful way to think about the gold to silver ratio, simply how many ounces of silver it takes to buy 1 ounce of gold. That ratio recently dropped from just over 71 to under 69 in a single trading session. When that ratio falls quickly, it usually means silver is catching up to gold or outpacing it, which is roughly what you'd expect from a market pricing in both rate, cut hope, and an industrial demand recovery. Now zoom out. Because everything so far has been about the next few days, there's a slower, quieter story running underneath all of this, and it may deserve just as much of your attention because it doesn't resolve in a single Fed meeting. It's been building for years with no sign of stopping. Central banks have been buying gold at a pace that would have sounded implausible a decade ago. The People's Bank of China added nearly 15 tons to its reserves in June alone, its largest single-month purchase in years, extending a buying streak now running 20 consecutive months. What makes that notable is the timing. China did this buying during gold's worst quarterly price decline since the 2013 taper tantrum. It wasn't chasing a rally, it was accumulating through a correction on a reserve management timeline that has nothing to do with next week's headlines and everything to do with a multi-decade view of where it wants its national reserves positioned. China isn't alone. In a recent global survey, close to 90% of central banks said they expect worldwide gold reserves to keep climbing over the next year, about as close to consensus as you get among institutions that rarely agree on anything. In the past few weeks, there have been a couple of structural moves worth noting too. China pulling back on its paper gold trading activity, and Hong Kong completing what's being described as its first physical gold settlement of this kind. Individually, these sound technical, almost bureaucratic. Together, they point at the same theme: a slow, deliberate shift among a meaningful block of the world's central banks toward holding gold as physical reserve rather than as a trading instrument. Why would an institution with a multi-decade time horizon, access to serious economic research, and no need to generate short-term trading profits keep buying an asset that pays no yield through a period when its price was falling? The honest answer is that central banks aren't optimizing for next quarter. They're thinking about what happens to currency systems and government debt loads over the next 20 years. The backdrop is hard to ignore there. Total U.S. government debt crossed $39 trillion in gross terms earlier this month, with annual interest payments on that debt now exceeding $1 trillion a year on their own. That's not a partisan observation. It's arithmetic, and it's the kind of arithmetic that tends to make anyone managing a large pool of reserves think seriously about diversifying away from any single currency, including the dollar. It's worth being careful here because there's a version of this that turns into fear-mongering, and that's not useful to you. Debt levels this large don't mean a currency collapse is imminent, and nothing in the data suggests one is. What they do mean is that the incentive structure facing large institutional holders of reserves has shifted gradually over the past several years, and gold has been one of the beneficiaries of that shift. That's a trend playing out over years, not days. The Comex signal we started with is a short-term technical read on physical tightness. The central bank buying pattern is a multi-year read on reserve diversification. Both can be true. Both are right now. So where does that leave prices heading into the 29th? Worth going through this honestly, including the disagreements, because a story that only shows you one confident number isn't giving you the full picture. On gold, the World Gold Council's mid-year outlook suggests a fair value range centered around $4,100, plus or minus roughly 5%, assuming conditions don't shift dramatically, and that estimate already assumes some chance of a rate hike later in the year. Bank of America, on the other hand, cut its full-year average gold forecast by around 14% earlier this month, citing a stronger U.S. dollar as the main headwind. Those two views from two serious institutions don't fully agree, and that disagreement itself tells you something. Even professional forecasters are genuinely split on how the rest of this year plays out. On silver, the spread of opinion is wider still. The London Bullion Market Association's most recent analyst survey put its consensus estimate for the year at just under $80 an ounce. JP Morgan's base case sits close to 81. HSBC is more conservative, around 75. Goldman Sachs, at the bullish end, has floated a range as high as $85 to $100 as achievable under the right conditions. Compare that to where silver actually started this month, just under $59, roughly half of the all-time high it touched back in January. Every one of those forecasts implies meaningfully higher prices from current levels. None of them are guarantees. They come from firms whose job is to be wrong less often than everyone else, which is a very different thing from being right. On the technical side, there are specific levels worth knowing, if only because so many traders are watching the exact same numbers. For gold, a sustained move above $200 would strengthen the case for a run toward $350, while failure to clear that level could send prices back toward $3,800. For silver, the $55 to $64 range has become the key battleground. A decisive break above 64 opens the door towards 72, and from there some technicians see a path back toward the $100 level that seemed unthinkable a few years ago. None of this is prediction. It's simply the lines in the sand a large number of market participants are watching, which on its own can become a bit self-fulfilling, at least in the short run. Here's a balanced way to think about what could happen on the 29th, laid out as scenarios rather than certainties. Scenario 1, the Fed holds as expected, and Warsh's language leans toward openness to a September cut. That's broadly what's already priced in, and metals could see a modest, controlled move higher, particularly in silver given its amplified sensitivity. Scenario 2, the Fed holds, but the press conference leans more hawkish than expected, emphasizing sticky inflation risk and keeping a hike explicitly on the table for later in the year. That's roughly what happened after the June minutes, and it could produce a similar pullback, hitting silver harder than gold given how much silver has already run. Scenario 3, the low probability outcome sitting around 20%, an actual surprise hike. If that happens, expect a sharp, fast repricing lower in both metals, with gold potentially testing the $38,000 to $40,000 zone the World Gold Council flagged as its downside watch area, and silver giving back a meaningful chunk of its recent gains quickly. Notice that in none of those three scenarios does the underlying structural story disappear: the physical tightness on Comex, the multi-year central bank buying trend, the silver supply deficit. A hawkish surprise can produce a short, sharp pullback in price. It doesn't undo 20 consecutive months of central bank accumulation, and it doesn't manufacture new silver mines to fix a structural deficit. Short-term price action and long-term structural trend move on different timelines, and mixing them up is one of the more common mistakes casual investors make when they watch a single news cycle and assume it changes everything. There's a genuine counter-argument worth taking seriously too, because a fair account of this has to include it. Skeptics of the physical tightness narrative point out correctly that registered Comex inventories can and do refill quickly when prices rise high enough to make it economically worthwhile for metal to flow from private vaults, from London, or from other markets into Comex warehouses. Registered silver climbing more than 10% over the past month is itself evidence that the system responds to incentives rather than simply running dry. A rising coverage ratio driven by fresh registrations is a very different story from one driven by falling open interest out of fear. It's fair to argue that a coverage ratio in the high teens, tighter than average, is still a long way from the single-digit readings that have historically coincided with genuine delivery crises. Healthy skepticism here isn't cynicism, it's just good practice, whether you're watching a Fed decision or a warehouse report. So what does this actually mean if you're trying to make sense of your own portfolio rather than trade this week's headline? A few things worth sitting with, none of which is advice on what you specifically should buy or sell, because that depends entirely on your own goals, time horizon, and risk tolerance. And no YouTube video should pretend to know those better than you and a qualified financial advisor do. First, understand the difference between short-term catalysts and long-term structural trends, since they call for very different levels of attention. A Fed meeting is a single-day event. 6 straight years of silver supply deficits or 20 straight months of central bank gold buying doesn't resolve in an afternoon. Second, pay attention to language and not just decisions. The Fed's tone in a press conference has repeatedly moved these markets more than the headline rate decision, and that pattern will likely repeat on the 29th. Third, remember volatility cuts both ways. Silver moving 2 to 3 times gold's percentage swings is exciting to watch, but that amplification works in reverse just as easily as it works to the upside. Fourth, Keep watching what happens after August's first notice day passes. That will tell you whether this month's physical tightness was a temporary blip smoothed over by fresh registrations or the early edge of something that keeps showing up month after month. There's a broader point buried in this whole episode that goes beyond gold and silver specifically. Markets are layered. The price quoted on your phone is the top layer of a much deeper structure: futures positioning, physical delivery mechanics, central bank reserve policy, sovereign debt dynamics, all stacked underneath a single flashing number. Most of the time, you don't need to look past that top layer. Every so often, the layers underneath press against each other in a way that's worth understanding, even if you never plan to trade a single futures contract in your life. This is one of those moments, arriving right alongside one of the most closely watched Fed meetings of the year. Back to where we started, a relatively obscure warehouse signal on Comex and a genuinely uncertain Federal Reserve decision are converging on almost the exact same handful of days. Neither one on its own tells you with certainty what gold and silver do next. Together, they explain why so many serious analysts are treating this stretch of the calendar as more consequential than a typical weak physical tightness on one side, monetary policy uncertainty on the other, and a structural, multi-year central bank buying trend running quietly underneath both. Whatever the Fed says on the 29th, the underlying story was already in motion long before this week. The deficit in silver supply, the reserve diversification among central banks, the growing industrial appetite for silver from solar, electric vehicles, and the infrastructure powering artificial intelligence. It's likely to still be in motion long after this particular news cycle fades. So here's what I genuinely like to know from you. Do you think the Fed holds and stays quiet on September, holds but leans hawkish, or actually surprises the market with a hike? And separately, are you watching the Comex physical data at all? Or is this the first time it's crossed your radar? Drop your take in the comments, because these are exactly the kinds of predictions worth revisiting once the dust settles and we actually know how this played out. If this kind of deep, honest look at what's really moving the metals markets is useful to you, a like genuinely helps this reach more people who'd benefit from understanding it too. And subscribing means you won't miss how this story develops once the Fed decision actually lands. And if you want the fuller picture on why central banks have been buying gold at this pace for years now, there's another video on this channel that walks through exactly that story from the beginning. It's a natural next stop from here.